Welcome to Nasdaq TradeTalks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from the Singapore FinTech Festival, and joining me for this segment, we have Pham. She is Commissioner with CFTC. We're here to discuss the convergence of traditional finance and digital assets. Caroline, it's great to have you with us. Welcome to Trade Talks.
Thank you so much.
You got it, and certainly a hot topic for our Trade Talks audience here. When you think about the potential that blockchain technology has and the financial market infrastructure, what are some of those convergences that you're seeing there?
So I think the most compelling use case that people have been working on, and that actually my Global Markets Advisory Committee will be having a vote on a recommendation on November 21st, is the use of tokenized collateral. Because of the benefits that it brings from an operational perspective, greater efficiency, perhaps the ability to expand the pool of assets that can be pledged as non-cash collateral, resolving some issues, for example, with money market funds and how they're redeemed. And then also, of course, the fact that it can help to speed it up. You know, you can have the posting of tokenized collateral happen on a 24/7, 365 basis if that's what you want. And of course, as you know, the chain of intermediaries that is involved in order to move collateral from one place to the other can be challenging, particularly when you've got intraday margin calls and so on and so forth. So I think when you look at the real operational efficiencies that can be gained, and then also not worrying about things like settlement fails, that's what I think people are really find compelling.
Yeah, it seems like that's really the next catalyst in terms of more institutional adoption of this type of technology, more so than some of the products that are being put out there more. It just seems from an institutional asset manager perspective that this makes sense on a number of levels, being able to integrate these two types of technologies. What are some of the steps U.S. regulators could take to provide greater certainty for innovators and for developers that are in the digital asset space looking to get in there if they're thinking about partnering or integrating their systems? What are some of the steps that U.S. regulators could take? Because that seems to be another hurdle that needs to be crossed for mass adoption to continue to grow.
So generally, it's preferable for regulators to take a technology neutral approach, because obviously technology is always evolving and changing, and there's always technological advancements. So I think of how the CFTC rules used to be written specifically to punch cards and microfiche. These are technologies that people do not use anymore, and we had to actually amend the rules in order to remove those references because they were obsolete. So when you have a more technology neutral approach for something like books and records, that can really help to not prevent or impede people from using superior technology that has the benefits from operational efficiency, lower cost, more secure, less reconciliation issues, that kind of thing. So if U.S. regulators take the approach that they traditionally have taken with a technology-neutral approach to infrastructure technology, right? This is just the pipes and plumbing. This is the middle office and the back office. Then there shouldn't be impediments to using blockchain technology. Just the same way that we saw electronification of markets, right? Moving from paper tickets, paper orders, writing those down, recording them again, everything that went into that process. So we saw electronification of equities first, of course, Nasdaq, and then we still are undergoing electronification of fixed income markets. So people do see, once you get the collateral piece solved, right, I think this is, to your point, where the institutional adoption can really kind of provide that value add that makes it worth the investment in the new technology. And then you could start to see perhaps uses to increase liquidity and efficiency in fixed income markets, perhaps in corporate bond markets. There are corporate bond issuances that are happening here in Asia, in Hong Kong, for example. So it's really an evolution. Now, a key aspect that will need to be solved for is the cash leg, because of course you need a settlement asset. So that's, I think, actually not so much about can you use blockchain technology, because why shouldn't you be able to use blockchain technology? What's the difference if it's electronic or tokenized? But more about how do we solve for the cash leg so that it can move at the same speed as the non-cash collateral. Because right now, moving money from one end to the other, of course, involves a lot of cross-border issues, and it uses the banking system, which is not 365, 24/7.
So, and I guess that's what the question is how other parts of the world are either embracing this or are putting frameworks around it. Is it because, to your point earlier, that it does take time for U.S. regulatory frameworks to evolve? It's not something where you can just like cut and paste into a new type of framework or just develop one from its infancy. There are rules and regs that are in place that do require time to evolve and to be legislated at the end of the day. So it's a slower moving thing.
Yes, but I actually think the reason why in the US we've had this challenge, because tokenization has been explored, for example, coming back to Singapore where we are, tokenization has been looked at for wholesale markets, for institutional markets since 2018.
Right.
With partnering with some of the biggest financial institutions in the world. So in the US, I think it's an issue of the political environment and the political will. If the policy is that we're not going to embrace new technology, that we're going to have an allergic reaction to new technology, let's say, then of course the regulators are going to really discourage firms, if not outright prohibit firms from using the technology. But if we have an approach that again is technology neutral, that is principles based, that it's not an allergic reaction to new technology, then I think we move forward. So many people say that in Washington, personnel is policy. So it's all about the leadership and what's the policy agenda and how do we feel about new technologies.
All right, appreciate the insight, Caroline. Thanks for joining us on Trade Talks. And thanks for joining me from the Singapore FinTech Fest. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.